Paramount Skydance is victorious in the battle for Warner Bros., vanquishing Netflix. And both stocks, Paramount, Skydance, and Netflix, have enjoyed one hell of a rally on the stock market since news of this victory broke late last week. On Monday, March 1st, David Ellison, the CEO of Paramount, conducted a special investor call where he lent his thoughts on what his vision for the future is when it comes to the conjoined company of Paramount and Warner Bros. And then, of course, how tampons played a role in the what? Renegade Online. Well, folks, welcome back. Another great day here at Valiant Renegade. It's good to see all of you out there once again. And if you are like one of the many watching this video, not yet subscribed to this channel, please take a moment and turn that little red subscribe button to gray. Hit that like button, hit that notification bell, share this sucker out on the social medias, and of course, please do leave a comment before you head out the door today. Make sure to join us every Sunday and Wednesday afternoon right here for the live show. On Monday morning, David Ellison and Paramount gave us a look into the future of the combined company with Warner Bros. And these are some of the slides from the presentation. Let's go through some of the high points and then talk about some of the media reaction. One of the big standout elements in this call was having David Ellison reconfirm yet again that they are committed to a very, very robust theatrical release slate in the future. And I do mean in the future. 30 theatrical projects annually. Now, of course, these are going to be pretty wide-ranging. I don't expect to see 30 titles coming from a combined Paramount and Warner Brothers all coming in with $100 to $200 million budgets. There's going to be a lot of smaller films in there, horror, drama, rom-coms, these kind of things that are going to have quite a wide array of costs that go along with them. But 30 films annually released into theaters. Now, this is something that a lot of people understandably have had some doubt on, considering that Paramount hasn't been very robust in years of late in releasing a lot of titles. In fact, probably the smallest or fewest number of titles released by a major Hollywood studio in the last couple of years. But then again, David Ellison has only been around at Paramount since August of last year, 2025. And at the same time, even though they have already started greenlighting a number of theatrical projects for down the road, most of his attention since coming in August of 25 was to turn right around and start targeting Warner Brothers for another purchase, which now looks like is going to happen. So don't be surprised if it's going to take another 2 or 3 years before we see a combined Paramount and Warner Brothers ramp up to 30 releases per year.
Wait till I get going.
But let's look at some of their really high points here overall at the 30,000-foot view. Expanding creative engines at the core of Paramount and Warner Brothers Discovery. Prolific producers of celebrated and culturally impactful content. Vast TV and film library supported by marquee franchise IP. Cutting-edge gaming and interactive content capabilities. Establishing a premier direct-to-consumer platform to increase competition and drive growth. And this is a key area that people in Wall Street especially really need to focus in on. Strong competitor in streaming with 200 million plus global subscribers. And hoping to get to between these two, or really 4 if you count Discovery and Pluto TV separately, integrated platform delivering superior user experience. Now, I know that all sounds like corporate pablum, and granted, you'd be right. But let's peel back the layers of the onion for a moment here. And this is one of the things that we've been talking about on Valiant Renegade since this thing began several months ago. If you take something like HBO Max and throw in Pluto and Discovery, and then throw in Paramount Plus on top of it, the question becomes, how many of the subscribers between these services are already duplicative? Now, we know for sure, like with Disney and Hulu, there was a good bit of overlap when they combined those services. One of the things that we brought up, people assuming that all of Disney Plus subscribers would be additive to Hulu subscribers and vice versa when Disney merged those two enterprises. Well, no, of course, there was already tremendous overlap between subscribers having both Disney Plus and Hulu by themselves before. So we'll have to wait to see how it really shakes out in the next year or two once those are fully absorbed into one another. But then when we looked at Netflix and Warner Brothers, one of the things that stuck out at me when that was on the table of being a possible M&A, Netflix and Warner Brothers in some form or fashion had a near 80% overlap in subscribers, to which I posed the question, if that's the case, then how do you make this a value additive proposition to Netflix should it have acquired Warner Brothers? The problem is, keeping HBO Max and Netflix completely separate subscriptions, separate services, separate login, separate technology running each separate service would become financially cumbersome and frankly wasteful very quickly. It would behoove Netflix to coalesce the library of HBO Max into Netflix itself at some point down the road, frankly sooner rather than later. The problem is, what then do you do? As all the subscribers on HBO Max, or nearly 80% of them by some reports, were duplicative as to the ones on Netflix. Would you then suddenly charge Netflix subscribers in their entirety an extra $10, $15 to $20 a month to not lose the revenue that you would otherwise have coming in from an HBO Max subscription? It was going to be very difficult. Paramount Plus, on the other hand, was a little bit leaner. The premium subscription for Paramount Plus still currently stands at around $12 or $13 a month with no ads, as opposed to $20 plus or $22 a month with HBO Max. But when it comes to Paramount Plus, the overlap with HBO Max is far smaller than it is with HBO Max and Netflix, meaning that this is actually going to be tremendously additive once these services are combined. Obviously, HBO being the bigger of the two, and frankly, a name that David Ellison seems none at all wanting to get rid of.
The name, that glorious name.
And then there's this one right here that a lot of people will overlook because of cord cutting and that linear TV is a dying asset. But hang on a second. There's still some blood to squeeze out of this turnip yet. Diverse package of networks serving audiences in 200 countries. Well, that's quite a few. That might even be as many as Netflix or more. Might even be as many as Disney Plus or more, or close to it. 200 international territories. Well, now we're starting to scale up, and we can see where this thing is going. A complementary set of networks well-positioned to manage linear pressures, diverse international portfolios serving 200 countries, distributor of marquee U.S. and international sports, including the NFL and the Olympics, and trusted deliverer of news and thought leadership. And granted, yes, we can make all the CBS and CNN jokes we want, but hang tight on that.
Very much prompted by or a result of many things, including...
This will be a key element for revenue driving in the future and cost cutting. And that's another element that has concerned a lot of folks out there, especially in Hollywood, worrying about how many layoffs, how many job losses would happen because of this merger. It seems to me that it might be less than we're imagining, and maybe not in all the areas that we think. Certainly, I think we'll see some job cuts, perhaps significant in the advertising realm. Because if you're Paramount and you've already got a massive advertising core, people working on the ground to sell ads for CBS and Paramount Plus and so on and so forth, and you have a duplicative set of advertising executives at Warner Brothers right now, selling things for, say, the ad-based tier of HBO, for Pluto, for TNT, and the sports packages they still do have, so on and so forth, you probably still don't need all those guys. There's probably going to be a lot of folks there that will be let go. But here's the thing. The good news is when they cut the costs between these two massive advertising divisions at Paramount and Warner Brothers, and while at the same time being able to massively scale up the amount of offerings, i.e. programming on television, be it through streaming or be it on linear, that the advertising section will be able to offer, that means that they will be able to create and secure, hopefully, far more financially lucrative and larger advertising packages to the same advertisers they have now. Think about Warner Brothers advertisers now being able to access not only a slate or a package on HBO Max and Pluto and TNT, but now having access to the powerhouse that is CBS, especially during NFL season with all of those Sunday games that they get with the AFC. So here's the big kicker on the transition for P-Sky and WBD. They expect to realize about $6 billion in run rate synergies within 3 years post-closing, guided by the P-Sky transformation plan, including, number one, consolidating streaming technology stacks. Easy. This is DTC, direct-to-consumer streaming. We don't need to have a separate HBO Max service and a separate Paramount Plus service with Pluto lingering out there. All of these things can be combined into a unified technology package. Now, there may still be segregations in the subscriptions, certainly with Pluto being their fast operator for streaming or their free advertising streaming service. And then they're probably going to want to scale that up over time, putting more and more content there that would otherwise lie dormant, not only on HBO Max right now, but also on Paramount Plus for that matter. If it's not, of course, also being licensed out for cash money to people like Netflix, third parties, that absolutely unequivocally Paramount Warner Brothers will still continue to do. But interestingly enough, David Ellison suggested that he certainly did not want to cough up the HBO brand name. So perhaps we could expect something like HBO presented by Paramount or Paramount HBO as the name of the streaming service in the future. In addition to that, rationalizing a real estate footprint and corporate overhead, global business services and procurement efficiencies, driving efficiencies in marketing, optimizing spend on agencies and tooling. And this is one of the big things, the efficiencies in marketing. Again, listen, when Netflix was recently asked about how they would look at global prints and ads if they were successful in the Warner Brothers bid and still was going to commit to the Warner Brothers theatrical releases and give it a 45-day window before it went somewhere, maybe PVOD, maybe Netflix itself. We never really got a straight answer on that one, but they said that we don't have to spend a whole lot on global P&A outside of our own borders because you've got 300 some odd million subscribers on Netflix. They're going to Netflix to see what's on TV. We've talked about it for years. Netflix is a bit unique in that case. People typically don't go shop necessarily on Disney Plus, for example. In fact, nobody shops to go see what's on TV on Disney Plus unless they're 5 years old. Some people shop on HBO. Fewer still will go shopping on Peacock or Paramount Plus. And yes, even some on Amazon. But for the most part, if your name isn't Netflix, you're going to one of these streaming services, turning it on to watch something specific that you know is on there. Netflix has an amazing amount of advertising prowess just in and of themselves by being able to put up, go see this new movie right there on Netflix. Now translate this into Warner Brothers and Paramount, or HBO Max and Paramount together, scaling up to nearly 200 million subscribers, both domestic and internationally. That's going to give them a tremendous amount of advertising power within their own streaming service to continue to push and promote theatrical releases, something that Paramount obviously has done for nearly 100 years. That's going to scale down their cost for advertising, and I think we'll continue to see more and more Hollywood studios do that over time, and that's what they're looking at here. And what they're thinking about by the end of this year, should it be concluded by then, an estimated $69 billion in revenues with $18 billion in adjusted EBITDA. Now, that would be a hell of a thing. And they do say that includes the $6 billion in synergies, which they're also suggesting could take a couple of 2 or 3 years to come to full realization. So we'll have to see how that pans out. But even arguably more impressive, if they can hit it, is their midterm financial targets. Mid to single-digit total revenue CAGR, or compounded annual growth rate. Mid to single-digit or mid-single-digit annual CAGR would be something like 5 to 6% a year compound annual growth rate between now and 2030. Now, that would be great. But even better would be a mid-20% adjusted EBITDA margin by 2030. Mid-20%. If they could pull that off by 2030, they would basically be rivaling what something like Netflix did in 24. That would be pretty impressive, especially with all that baggage they're going to be dragging around like debt.
Not so fast, buddy. You ain't paid yet.
And again, let's take a look at what's happened to Netflix's stock since they bowed out. It has gone from $75 a share when they were at their worst point to now over $97 a share at the close today on Monday. And Paramount Skydance just last week hovering at around $10 a share, and at one point was up as high as $14 or over $14 a share today. Again, both these numbers for Netflix and Paramount are just in the last 5 days. Goes to show you that the market has reacted overwhelmingly positively to both Paramount winning and Netflix walking away. But as we said before, not everybody is happy. Warner Brothers employees fear a coming wave of job losses as Paramount tops Netflix's bid to acquire the company. Now, this was an article on CNBC by Alex Sherman last week. But again, this morning, David Ellison seemed to try to allay some of those fears as best as possible, saying that, in fact, the majority of the cost synergies, that $6 billion figure over the next couple of years, will be coming from structural changes and cost efficiencies, technology efficiencies, things like combining the streaming services, probably scaling back on having 2 massive advertising departments. And obviously, they're hoping that the labor impact of these cost synergies will be minimal as much as possible. But if Warner Brothers and Paramount combined are going to make good on their 30 picture per year promise in the next couple of years, certainly it seems like the regular rank-and-file Hollywood folk, like members of IATSE or folks at the Writers Guilds and the Directors Guilds and so on and so forth, the people that work behind the scenes on these film and television production projects, are going to hopefully be able to keep going on just as they have been without much interruption. It seems like a lot of the labor cost reduction that's probably going to happen under these combined entities is going to happen on the SGA side, or the selling, general, and administrative. And finally, as promised, yes, apparently tampons even had an impact on this deal, or at least according to Charles Gasparino.
Let's keep in mind where this started.
And in one of the funnier and more unexpected bits, Charles Gasparino says there were many defining moments featured in the months-long battle for the ownership of Warner Brothers Discovery. Sit-downs to woo President Trump, high-profile congressional hearings, a brutal bidding war, and a tampon. Yes, a tampon. During the negotiations, while Netflix was telling skeptical GOP lawmakers that it wasn't a left-wing company looking to get more powerful by snapping up Warner Brothers Discovery, a delegation of legislators paid a visit to its headquarters, and one was both shocked and disturbed to find a basket containing tampons in the men's restroom. I don't know what you want me to say on that one.
This is what we need in here.
But the final key thoughts to note from the investors' call this morning, David Ellison seemed to make it very clear that movies should be seen in theaters. His words. He also said that he doesn't think artificial intelligence should replace working capital or human capital in this case. It should be a tool for creative artists. In addition to that, David Ellison seemed to also make it very clear they have no plans to do any type of spin-offs or sale of any of the linear assets as of right now. Now, of course, that could change a few years down the road if they find some that are grossly underperforming others. But I think right now they bought what they bought because they wanted what they bought, and they're not intending to change it. And by the way, those 30 theatrical releases a year are coming with a commitment to a minimum 45-day window. Not just a 45-day window, but a minimum 45-day window. So obviously, with the pictures they put out into theatrical distribution for the ones that overperform expectations are probably going to get a lot longer run. Now, the last hurdle for these guys to get over, obviously, is the regulatory environment. But Ellison once again reiterated this morning that they have passed the litmus test so far for any legal intervention by the United States. Now, that may change. Certainly, we have places like California out there that want to launch investigations, but I have a feeling that's going to be quelled rather quickly. Ellison even went on to say that they are already well in process with the European Union regulators and don't seem much concerned about getting through the process there. This thing may well close by September 30th, and if not, I don't think it'll be too much longer after. But hey, if it is, Warner Brothers shareholders will get an extra bumper of 25 cents per share per calendar quarter that it goes beyond that. Let me know your thoughts in the comments below, and we'll catch you on the next one. Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.